Welcome, folks. I'm here to do a review video of NASDAQ. We're going to be analyzing ICT concepts in this video. Going to be doing some short analysis on the morning session here. This is meant to supplement your training of ICT. You should be using his free videos that he provides on YouTube. No reason to be paying money for everyone else's videos when you can learn concepts are free, and I think his are the best way for learning how to trade futures. All right, so we are looking at the daily chart on NASDAQ here. This is before the Thursday open today. And we're just going to mark out some levels that we would want to be interested in. The previous day's low is a level that we need to keep an eye out for. It's a daily low. And if we look at the hourly chart, we have some highs that we want to be aware of. Relative equal highs. And if we look at a 15-minute chart, we still have those relative equal highs there. Okay, so here we're at 9:29 just before the open. And before the market opens, we want to mark out our opening range gap. So we want to mark out, go on regular trading hours, and the 414 candle, and this is all going to be in Eastern Standard Time, so New York time. That's what ICT uses. That's what we need to be using. So at 414, we're going to mark the close on that candle. That's your opening range gap close. And then on the 9:30 open, that's going to be the open of our opening range gap. So we have the opening range gap high right here, and then the opening range gap low. But we don't want to just get into a trade right at the market open. We want to see how the opening range develops. So the market immediately fills in the opening range gap right here at 931. Now we have to be patient and wait. The best time is to wait for the 10 o'clock macro and for the silver bullet. Those are going to be your best trades, especially if you're just starting out as a beginner. That's the way to go. And you want to note, always want to note your first presented fair value gap. So the first fair value gap that forms after 9:30. So you can't include the 9:30, it has to be 9:31 or later. And when you're noting your fair value gaps, if there's a volume imbalance, you want to include the little volume imbalance right there in your fair value gap. So here's our first presented fair value gap. And we want to see how price reacts off of that. And we're also watching to see how price reacts between the opening range gap. So you see here we failed to get up into the first presented fair value gap and we left it open. But we still don't have a trade. The 10 o'clock macro starts at 9:50 and ends at 10:10. It's going to be one of the best times to be placing your trades. Okay, so now we're right at 950, and price came back up into the first presented fair value gap. Still don't want to make a trade yet. We want to see how price reacts to this. So price is hanging around this first presented fair value gap, but we haven't had a body close giving us a direction yet. We do want to note here that market structure has shifted bullish. So as of right now, if we're going to be looking for a trade, we would want to see price leave this first presented fair value gap and perhaps come back into it. We want to leave it, come back into it, and then look for a trade to take out these highs here. If this has not occurred yet, we still don't have a trade. On this candle, you can see we came all the way back up, but we closed right here by the first presented fair value gap, so still no trade. Okay, so we still have to be aware we're still in bullish price action because of this market structure shift here. And now here we have these two candles. Look at the bodies and the wick on this candle. Price is respecting the consequent encroachment of the first presented fair value gap. So the consequent encroachment is the midpoint level of a gap. And you can see the bodies respecting that perfectly there. And then price drops. So on that candle there, we now have a market structure shift bearish. So as of right now, we should be looking for lower prices. And if we're looking at a higher time frame, say a 15-minute candle or a 15-minute chart here, we want to see where would price be drawing to. If we are bearish, well, we have this low here. But here, what stands out more is we have two relative equal lows at 1645 from Wednesday, and then just as the market opened up after the close on Wednesday. So those are relative equal lows, and that's going to be a target for us if we are bearish. And you can see our daily low down here. So back to the 1-minute chart, we have a market structure shift bearish there. And we are inside our 10 o'clock macro time. So here this candle is 10:05. Now you can see this candle here, the order block. So price left at a market structure shift bearish. So this candle here is a bearish order block. And you see this candle opened up, just tapped in to that bearish order block right there at 18,459. It just tapped it, and then look at the reaction, immediately went down. that would be a perfect trade entry right here. That's going to be your trade for the morning session. Where does your stop loss need to be? Your stop loss needs to be above the first presented fair value gap. You can go above the swing high here. So this would be your stop loss. So from your trade entry, your stop loss is about 30 points. So you're going to be risking 30 points on your trade. And where is your target? Well, your initial target is going to be this low created at 946, but your final target is these relative equal lows. If you were to take a trade from here and target that, that's 80 points of profit, and towards the relative equal lows will be 120 points of profit. So that's going to be where you want your trade. Now here we see price is still bearish. Order flow is on our side. Now we're coming back in to the opening range gap. Here's the close on the previous day. That's where our opening range gap is. And notice since our trade, we don't have any fair value gaps in here. And then you can see the reaction again. The bodies are right there at the close, right at the opening range gap. Now right here, here is a fair value gap that we created. Now this is going to be your silver bullet for the 10 o'clock hour. Price is respecting the first presented fair value gap. Price is bearish. We create a fair value gap here. Price comes right back up into it. So right here, if you missed this trade up here, if you didn't see this, here would be another great opportunity to get in short. Now, if you were getting in short here, where does your stop loss need to be? It at least needs to be above the candle that's creating the fair value gap. So it would at least have to be right here. Now we do have this swing high that's formed. We have this wick, which is relatively large compared to the other wicks here. So we can see, we can check the consequent encroachment of that wick. And we could place our stop loss just above the consequent encroachment of the wick. So if you were to get in right at that fair value gap, your risk on your trade would need to be about 35 points. Now you could put your stop loss just above that candle, risking 20 points. But it'd be a little bit safer to go above the consequent encroachment. So you're risking about 30 to 33 points there. And our target's still going to be the same. We have our initial target, which would provide you 40 points of profit, and your final target would give you about 80 points of profit. So that's going to be your trade, your silver bullet for the morning session. So now we just hit our first target there. Now if you're only trading one contract, you can place your exit and take 40 points of profit in just 4 minutes. You have your 40 points, $800 with one contract, and you're done for the day. If you're trading multiple contracts, you could take a partial right there, move your stop loss to break even, and see if your final target down here, the relative equal lows, see if your final target will be hit. So price is still bearish, and then right there, 1027, we hit our target, our final target, which will give you 80 points of profit. That's going to be your trade for the morning session for NASDAQ. We exit replay mode here. So those are going to be our best trades, trading at the order block, prices respecting the consequent encroachment of the fair value gap. The prices respecting first presented fair value gap. We drop, creating our market structure shift. As soon as we drop below this candle here, we have our market structure shift. Drop lower, we come back up into the bearish order block. We drop again, come back up. You notice we just tap it right there. If you include the wick, you are hitting that bearish order block perfectly. What's the low of this candle? Look up here, right there at the low. 18,457.50. And if you look at the high on this candle, 18,457.75. So it hit it, just one tick. And then look at the reaction. We dropped, the bodies are below the opening range gap. Everything is indicating we are bearish here. We create a fair value gap. We create our silver bullet. That's going to be your silver bullet entry right here. And then price takes out the low created in the opening range from 9:30 to 10 o'clock is our opening range. So we created a low here, we took that out, and then we took out the relative equal lows on our 15-minute chart. This is our final target. That's going to be it for today, folks. Keep an eye out for more review videos.